Hey guys, this is Toby, and today we're going to go over the 8 tax secrets the wealthy use that you've never been taught. So most people think that taxes are just about reporting what you made last year, but real tax planning starts with understanding that not all income is treated the same. So here's a simple example. Imagine 2 houses sitting side by side on the same street. Like they're colored the same, they're exactly the same. One is owned by a family who lives in it, and the other is owned by someone who rents it out to other people. Same street, same type of house, but completely different tax treatment. The family in the first home that lives in it, they might get a mortgage deduction if it exceeds their standard deduction. They don't get to deduct their utilities or repairs. It's just their personal residence. The owner of the rental, however, may be able to deduct, they get to deduct their mortgage interest, their property taxes, their insurance, their repairs. They even get to depreciate and get a deduction on the home. They're both homeowners, right? But the IRS looks at their situations very differently through different lenses. And that's the foundation of planning. The type of income matters. So let's go over the main 3 types of income. Number 1, the one that gets beat on the most, is wages or self-employment income. It's earned income. Some people call it active income. It's taxed at the highest rates and often comes with payroll taxes on top of it. If you're a sole proprietor, if you're earning W-2 wages, whatever, you are getting hit not just with federal income taxes, but you're also getting old age disability and survivors, Medicare. You're getting hit with employment taxes. Whack, whack, right? 12.4% and 2.9 plus whatever your Fed is. There are some phase outs and there's some things like that, but it's a big tax hit. And the way to think about it is every time you make an earned dollar, you're getting a little whack, right? Then there's passive income. And there's really 2 types of passive income that are out there. There's either rents, so I'm renting out a property, or there's businesses that I do not materially participate in, right? I am not actually working for the business. So if I open up a pizza shop with somebody, and let's say it's Kenny is that other person, and Kenny's working his butt off in the pizza shop. I am an owner, but I am not. I am not showing up. I don't do anything for the business. When that money rolls down, it's earned income to Kenny because he's working. That's active for him. Me, I'm passive. The beautiful part about passive income is it's not subject to employment taxes. So I get passive income in that situation. Now, the problem with passive income is that it can only be offset, or it gets offset by passive losses. Put it another way, passive losses can only be used against passive income, except in a few exceptions, like real estate professional status, where it can trigger it into something else, or if you dispose of an activity. But there are some rules around passive income. But investors love passive income. And then the 3rd type of income is portfolio or capital gain income, right? Portfolio income includes capital gain income. And these are like stocks, when you sell property, investments that you sell, it can be taxed as capital gains. And the beautiful part about capital gains is oftentimes, if you hold it for over a year, you get these things called long-term capital gains, which are about half or sometimes less than half of what you're normally being taxed on activities. So for example, for somebody, maybe you're married filing jointly, you could be in the 0% long-term capital gains rates all the way up to about $90,000 plus, right? Imagine that you have your standard deduction too. So you could be making $120,000 a year, and if you're selling stocks or something like that to help make your living, you may be taxed at 0. That's a beautiful tax rate. On the high end, even if you're making $1 million a year, you're still capped. The top long-term capital gain rate is 20%. Now there is something called a net investment income tax that gets thrown on there, so a lot of people say it's 23.8. But the point is that it's not 37% that you'd get hit on if you were making your just regular old income, ordinary income. So there is a difference. And once you see that the tax code plays favorites, the natural next question is, how do I move more of my money into one of the favored categories and less money into the heavily taxed one? And that's where the 8 Ds of tax planning come in. I think of them kind of as levers that you pull to shift how income is taxed, when it's taxed, or whether it's taxed at all. So let's go into them. There's 8 Ds, no particular order. Number 1, though, is divide. Divide means to strategically spread income to different taxpayers or entities. Why? Because not everyone pays tax at the same rate. So, let's say that a client has a landscaping business and he hires his 2 teenage kids to handle marketing and bookkeeping. He gets to deduct the wages from his business's income. The kids, on the other hand, the money goes to them and they may be in the 0% tax bracket. Let's say he pays them each $10,000. Do you know that if it had been to the owner, let's say he's in the highest bracket, he's making a lot of money, it would be 37%. But because he shifted that income to his kids, 0% tax bracket, because they have the standard deduction. Well, this applies to entities as well. Maybe in a situation where you're trading, maybe you know that, gosh, the IRS really beats up investors and they don't let them have ordinary necessary business deductions and things like that, and except in extraordinary circumstances. So maybe you set that brokerage account up as an LLC taxed as a partnership. Maybe some of that gets shifted over, divided into the C Corp to take advantage of a 21% flat corporate rate. Maybe you're able to take advantage of Augusta rule, administrative office for the home, a bunch of deductions, and you're able to reimburse 100% of medical, dental, vision, and and the recipient doesn't have to pay tax on it. That's huge. Dividing income among the right structures can save huge amounts of money over time. So I'll just call that number one. And there's all sorts of ways to divide. I could divide it into a 401k, IRA. I could divide the money into even charities, into donor advised funds, all sorts of stuff. But I'm moving money that would ordinarily have hit me and I'm dividing it amongst others. It could be family members, it could be entities, it could be third parties even. It could be other structures, it could be retirement plans, it could be other things. But because I'm dividing it up, it's giving me a tax benefit. The next D is deduct. And this is where the tax code is really like an incentive manual. It says basically if you spend money in the ways the government wants you to on ordinary necessary business expenses for your business activity, for retirement, for health care, for education, things like that, oftentimes you can get a deduction. So let's say you have a doctor with a side consulting business who starts running his continuing education trips through his company. He does his meals, hotels, even part of his airfare. Like he's bringing in money. He's doing these things as a separate business, right? Then he can write those things off and it can save him thousands a year. One of my favorite examples is using the Augusta rule, where you rent your house to your business for up to 14 days a year, and the money that it pays you, guess how much tax you pay on it? 0. Because under 280 G2, you don't have to recognize it as income. You don't have to include it. So the business gets a deduction and you get that income tax-free. That's a deduction strategy hiding in plain sight. And there are a ton of them. Your meals, your automobiles. There's things like fringe benefits to employees that are non-taxable to the employees, deductible to businesses. There's all sorts of those things, but they fall under that category of deduct. And if you're starting to notice, hey, wait a second, it sounds like some of these things could actually be multiple Ds, you've caught on right. Because we have 8 Ds and some of them are going to trigger 4 or 5 of them. That's how you know it's an especially powerful strategy, because it's triggering multiple of those levers. And you're like, wow, this could be great. So another great example is you're going to hear about something called, we're going to go over a D called depreciation. That's also a deduction, right? It's doubling up. You get boom. But that's not where we're at now. Let's stop and go to number 3. And that third one is dump. And that's where you're getting rid of income in a tax smart way. So think about Bitcoin going up and down, up and down, up and down. Maybe I sell my Bitcoin at a loss when it goes down sometimes, right? And then you buy it right back. So you end up harvesting a loss. And yes, you can do that. The wash sale loss rule that applies to securities does not apply to Bitcoin. I always get somebody in the comments that goes, oh, you're going to do it. Yes, you can. And we can dump properties, like rental property that's at a loss. So I can use those suspended passive losses that might be stuck on that property and release them to offset other income. So let's say that a retired couple, they have a rental property, they sell it, and it's break even. Maybe they made a little bit, maybe they lost, but they unlocked a huge amount of suspended losses that were locked into that business that were locked into that rental property, and they became ordinary loss that can offset and wipe out other income that they have. That's called dumping, and you use it strategically to turn something that might be a headache into a cash savings. The fourth one is depreciate, and this is one of those big ones. If you're a real estate investor, this is one of your big friends right now because we have bonus depreciation back. But depreciation is one of the most powerful incentives in the code. If you buy property or equipment, the IRS lets you recover that cost over time. In other words, usually you're writing it off over 5 years, 7 years, 15 years, 27 and a half years, 39 years. There's a whole schedule. But there's something called bonus depreciation and cost segregation that allows you to accelerate a bunch of those. So even if I am financing, let's say I did real estate and I bought a $500,000 fourplex with financing, I could do a cost segregation study and accelerate, generally speaking, at least, probably $150,000 of deductions in year one. Even though, am I out of that pocket, that money? No, but I create a loss to wipe out tax on all my other rental properties. Sometimes, if I'm a real estate professional, I can even wipe out my consulting income or my W-2 income. Maybe I'm doing a short-term rental loophole and I'm unlocking it even farther, and it's offsetting my W-2 income. That is why there are so many real estate investors that have great cash flow, but they have zero to no taxes because they're using depreciation to your advantage. And you can do that on all sorts of things. Equipment in your business. Hey, I finance it, I buy it. I buy a car at the end of the year that qualifies, that's over 6,000 gross vehicle weight, and I use it 100% for my business. Let's say that it's, it does need to be legitimate. But hey, I finance it, I come out $1, I come out a few $1,000, but I get a massive deduction. That's why people use it. Now, there are a ton of those where I am buying equipment and things like that I'm able to put in my business that creates a tax loss on paper because there's that massive depreciation deduction. Right now you have two D's there. Let's go over delay. This is one that most people use. You don't even realize it, but you're using it. That is delaying when I'm actually going to be taxed on something. So let's go over to real estate again, and we might say there's installment sales where I'm spreading out the tax hit by delaying when I receive that money. I'm doing an installment sale. I'm getting payment over years on a property. So I sell it to somebody and they pay me over time. 1031 exchange, I'm not going to pay tax when I exchange. Maybe when I sell the property, if I don't pass away with the property and have a step up in basis, or maybe I just stop 1031 exchanging. Maybe I recognize it in the future, but I'm in control of that. I've delayed it. Opportunity zone investments. Again, I could be pushing it out as to when I pay taxes. You could be doing IRAs where I put money, I get a deduction on that IRA, and I'm delaying when I'm going to recognize that income until I am of retirement age and I'm forced to take it out as required minimum distribution. There's all sorts of things like that. Defined benefit plan, 401k plans where I am just pushing it out so that I don't have to recognize the income today. I'm getting a deduction today. Again, another D, right? I'm getting a deduction and I'm recognizing that income in the future. So let's say that a business owner sells his company and he structures the sale as an installment agreement over 10 years. So instead of paying tax on that money right now, he's spreading it out over many years. And why do you do that? Because generally the more you make, the more they take. You can get it into lower tax brackets. And you get to use that money in the meantime to grow your wealth, right? That's what you're doing is, hey, I got an installment sale. Number 6, donate. And a lot of people don't understand just how powerful using charities is, especially if it's your charity or you're using a charitable remainder trust or using a donor advised fund. Because charitable giving isn't just about generosity. It can also be a great tax planning tool. Instead of writing a check, consider donating appreciated assets. Let me give you a real life situation. I bought a house for somebody that I was taking care of that individual's mother who was blind. So this was legitimate. Hey, I am going to try to do something nice. I bought the house with the intent that I was going to actually sell it to him sometime in the future, that he wanted to buy it. It ended up not happening. So I had this property, and eventually I realized, hey, wait a second. I don't need this house. I bought it for $90,000. It was worth about $300,000. So I donated it to one of my charities, a charity that does financial stewardship, so that I could provide this lady tax-free, free rent, and I didn't have to worry about having to recognize rent even though she wasn't paying it. There's always some rules the IRS says. So like as an individual, if I rent to somebody and I don't charge them, I have to recognize it as though they were. Otherwise, they're going to have a taxable event. I'm going to have a taxable event, right? So I did this by giving it to a charity, and the charity was able to give her a grant to live in that house. But my deduction, I paid $90,000 for it. I held it for several years. Then I transferred it to the charity. My deduction was $300,000, which to me, I'm in the highest tax bracket, saved me more in taxes than it actually cost me for the property. And the rich do this all the time. Think of it like an investor who has $100,000 of stock that is doubled in value, and he paid only $50,000 for it. When he donates it, maybe he's giving it to a donor advised fund, maybe he's giving it to his own foundation, maybe he's giving it to a charity. He gets a $100,000 deduction, the fair market value of those shares. What is that worth to him? Whatever the highest bracket that's coming out of. So he's getting a huge deduction. So the charity got more, the IRS got less. You did well, you're helping charity, you're doing things for other people, but you're getting a huge benefit. And again, Elon Musk, all these folks, you see all these different foundations out there, and you're always scratching your head going, why? It's because donate is such a huge one. And remember, donation gives you a deduction. You've also divided, right? You're hitting multiple Ds, which is why that is such a powerful tool, which is why we like it so much. Number 7, disguise. Right? Again, we're not talking about hiding money because that's illegal. We're talking about choosing structures that legally present income in a better way. So for example, let's say that a consultant is running around there operating as a sole proprietor. And just by switching it to an S Corp, they've disguised their business, right, as an S Corp. It's still a business, but they went from just being themselves to an S Corp. Maybe they've incorporated it. Maybe they set up an LLC, taxes, an S Corp. But by doing that, that means that that money that is coming out is now, the profits are no longer subject to self-employment taxes. How much are we talking? It's like 15.3% on that extra money. So on $100,000, it may save you $10,000 a year. So the S Corp disguises part of your earnings as distributions instead of self-employment income. So in a C Corp, disguises it inside a 21% flat tax. Again, I can choose, there's 3 different flavors right there that I could choose to disguise my income as. And it's not illegal, it's simply saying, hey, I have this money that's being made, I get to choose how I'm going to recognize that. I could be a sole proprietor, I'm going to get killed in taxes. I could be an S Corp, I do a little bit better. I could be a C Corp, hey, it's not mine, but that C Corp, because of that, unlocks other benefits. There's fringe benefits. It could pay 100% of my medical, dental, and vision out of a C Corp, but it's now inside that C Corp. It's 21%, and if it comes out to me, it comes out as a dividend, which could be taxed as long-term capital gains, which could be 0. Again, we have all these different levers that we can pull and get benefits out of, but that is another D. How about the last one? Disinherit. And this is really kind of a big one for estate planning. And this is to make sure that Uncle Sam is not your biggest heir. Now, these exclusions of estate planning are huge now. 15 million, 30 million, right? There's just huge amounts of money that you can avoid. But if you're over those, you're going to get killed. You're going to get smashed. So we want to make sure Uncle Sam isn't your biggest heir. Without planning, estate taxes, probate, and forced sales can wipe out your family's legacy. So let's just say that you have a family with $10 million and they use trust annual gifting to move the wealth to the next generation. Instead of facing estate taxes, probating, maybe they use trust to avoid it, maybe they're directing someone to a charity so that we don't have to worry about taxes in the future, they are able to shield millions of dollars from something that could be a negative situation. So with planning, through trust, gifting strategies, charitable vehicles, even family partnerships or family LLCs, you can pass wealth efficiently to keep it in your family for generations. So there you have it. We just went over 8 Ds of tax planning. Divide, deduct, dump, depreciate, delay, donate, disguise, and disinherit. All right, and remember the 2 houses that were on the same street when I was talking at the beginning? The tax outcome isn't about the house. It's about how the owner planned. Tax planning is the same. It's not about how much you make. It's about how you structure it and how much you keep. Now, if this resonated with you, hit that like button, subscribe, and share. If this is somebody who's still, like if you know somebody who's just doing April 15th planning instead of year-round planning, instead of actually planning, share this with them. If you want to go deeper, check out our workshops. I'll put the links below so you can take a look at our tax and asset protection workshops. Sometimes we're doing them specifically on trading. Sometimes it's real estate, and you can see what strategies are available. Remember, these 8 Ds are very potent, and there's strategies that fall into multiple categories, and they go over them on these workshops, where we actually just go over a lot of real-life examples, and we show how real taxpayers, how they can put these strategies in play to save their money. Because at the end of the day, it's not what you make, it's what you keep, and that's what's really important. And it's all about you and your money, not about me, not about anybody else. When you're looking at these things, how do they apply to you? And that's what you're looking at. So leave questions in the comments, or if you like something, or I missed something, or if you have other strategies that you think are really great, or you want to just vet out, you say, hey, I heard this. Maybe you saw an Instagram or an X posting and you want to know if it's legit, put it down below. We'll vet it out for you, and we'll tell you whether it's legit or not, and we'll give you some good ideas. Thanks, guys. Until next time.